economic growth globally is decelerating and likely headed into a peak sometime next year. That's based on the indicators we watch most closely, and that's why we think it's important for investors to rebalance their portfolios, trim areas that have done very well, like the tech sector, back to a market weight, and even consider lightening up in areas that are excessively volatile. Between the unemployment rate and inflation rate, it's always been a good indicator of about a year before recession. Those two numbers become the same number, and we're still about 1% or so away.
What the Fed's doing is a double-edged sword. You want interest rates to go up so the next time a recession rolls around, they have some room to cut rates and stimulate the economy again. But on the other hand, you don't want the Fed to raise rates too quickly and cause the next recession. What the market's nervous about is if the 10-year stays where it is and the Fed actually goes through with the rate hikes that they're forecasting, you could see the yield curve invert. And 7 of the last recessions were preceded by an inverted yield curve.
We know that next year we're going to get significant fiscal policy withdrawal that's going to cause a decline in baseline growth estimates. And we also know with certainty that the peak impact of the Fed's rate hikes and the balance sheet from what they've already done and what they say they will do hits home next year in a very dramatic way. So if you're going to ask me, can we see a recession the second half of next year? I have absolutely no problem making that a base case scenario.
When we think about where the next recession might come from, we actually think it might come out of financial markets and into the real economy, as opposed to the normal way, which is real economy affecting financial markets and being reflected in financial markets. I think, yesterday's move is kind of a case in point. People are buying into all these stories. There's a story of tariffs. There's a story of, rising rates hurting home sales. And everyone's ignoring the actual earnings numbers or, the good news. And that's something that can happen when you have a week like this past week where there's just not a lot of data out.
There's a growing consensus, I think, within the Fed that they might feel they're now behind the curve on inflation, in part because of what Steve mentioned, that tariffs are stagflationary. This year, I don't have it taking anything off of growth. Next year could take a couple of tenths off growth. By 2020, we start to up the ante on the risk of a recession.
Part of what is being discounted now is the potential for the Fed making a policy error. Having said that...
And you think the policy error is increased?
Is that they go too quickly. Having said that, the chances of the U.S. going into recession, in my opinion, in the next year or two are exceedingly low. Jay Powell actually said there's no reason why the cycle can't last indefinitely. Now, most of the time when when the economy goes into recession, the Fed causes it. That's normally the way it works. So they're going to have to walk a fine line. But I'm very much in agreement with that. The best may be yet to come.
I don't think we see a recession, in the next 6 to 12 months. And the equity markets are typically reacting to a recession 6 months before. Yield spreads haven't really reacted all that much. So, it hasn't been a risk off across the board. It's really been concentrated in global equities.
It's lasting longer than the prior corrections that we've seen for the very reason the market is actually beginning to understand recessionary risks in, say, 2020 are rising. So I think in the short term, the market just wants stability. It wants earnings to keep coming through. It wants a trade tension not to show meaningful impacts on GDP growth on a global basis. In the longer run, as we move into 2019, we think the market's going to continually, increasingly looking at recessionary risk building, a lot of it having to do with that low unemployment rate that Rick just mentioned, and potentially the pressures that brings to bear on monetary policy, with the shape of the yield curve already in a warning sign.
That's what the Fed is trying to do. They're trying to stabilize the unemployment rate at very low levels in order to reduce the risk of a subsequent recession. In our forecast, the Fed brings the growth rate down to the potential rate, maybe a little bit below. The unemployment rate stops falling, late next year, early the year after, but the recovery continues. The economy continues to grow, but it grows at a slower pace.
The longest bull market on record, But this is also the longest Fed rate hiking. We have been hiking rates for 3 years now, and the economy has not turned down. You look at a country like Australia, there hasn't been a recession in Australia since 1991. We're not saying that's going to happen here, but there, as we just pointed out, there really aren't that many signs of overheating.
We are setting the stage for a recession to come within the next 12 to 18 months. That's very much the case. I think they are doing it partly because the Fed has ignored global realities, the fact that the Chinese developments with respect to debt, with respect to the trade war, are going to have a much bigger impact on 2019 than the Fed anticipates.
Well, I don't think a recession is coming this year. I don't even think a recession is coming next year, but I do think there is a risk of recession, and the risk is significant for 2020. As I look for a recession in 2020, I went all the way back to periods where we had a recession 1 to 2 years after the midterm elections, because after the midterm elections...
How many of those were there?
We have 1958, we have 1978, we have 2006, and guess what, Brian? 8.1% yearly return 12 months later.
A lot of the market message here is very suggestive that economic growth is going to slow quite a bit. Question is this 2007, where recession's right around the corner, or is it 1987, where you have a tough correction and then you still had 2-3 years left? And I kind of lean towards the latter view yet, but it's kind of a close call.